This is the Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Joining us again is a special guest expert on silver as well as the oil market, Steve St. Angelo of the SRSRocco report. It's great to have you back, Steve.
Yeah, hey Doc, how's it going?
It's going well, and it's been going well for gold and silver really over the past week and a half, ever since the March FOMC statement, where the market appears to be realizing that the Fed is kind of boxed in and not able to really meaningfully raise interest rates anytime soon. And when I say meaningfully, I mean other than maybe one or two small token rate increases. The market seems to be realizing that. Silver has rallied quite a bit, up over 17. Gold has rallied from about the 1140 level it was trading prior to the FOMC to over 1200. It actually just about touched 1220 Thursday morning on the news of the Saudi Arabia invasion. And then, really not too surprisingly, both gold and silver were smashed back down. The second half of the COMEX trading yesterday on Thursday, with April gold expiring, and gold was kept in a tight range trade the last really hour or two of the trading session, and kind of looked like managed into a 1205 close on the April gold options expiration, and really haven't had too much action here in early trading on Friday. We're recording a bit earlier than usual, just about the noon hour here Eastern on Friday. Gold has been tried to push under 1200, and as we speak here, it's rallying back above 1200. So, Steve, with that being said, what's your take here, particularly on the silver market, but gold as well?
We've definitely got out of the basement, and this is a good segue into what's. We'll talk about this in a minute. There's two ways to price silver. And briefly, it's the just-in-time price mechanism based on its cost and supply and demand fundamentals. And then there's a second, which I think is more important, which is what we are all waiting to happen, is the actual silver's store of value. The cost of producing silver, it's not its value. And if we look at the mining data, and I'm finally still waiting for a couple of small mines, but the full year 2014, the top 12 primary silver miners, they actually increased production from 92 million ounces last year, 2013, to 116 million ounces in 2014, and that was the addition of Tahoe Resources. But what's interesting, the break-even right now for 2014 is estimated to be about $19.15. So if we consider, even though the price of silver has gone up over the last couple of weeks here to above 17, right at 17, it's still about $2 now below the break-even of the top 12 primary miners as a group. And what's also interesting, the revenue for the year for these top 12 miners was $3.3 billion. So producing 116 million ounces, they had $3.3 billion in revenue, and their adjusted income was a loss of $57 million. So all that silver that the group produced, they lost $57 million in adjusted income. But that doesn't compare to the $1.8 billion that they lost in net income. And the reason why the net income was so high, they had more impairments. So the break-even price in 2013 was about $24, and now it's $19, so it's fallen $6. When I looked at my Q3 results for the last year, the break-even was $19.50. So I don't see, even with the price of oil being fallen in half over the last 8 months, I don't see much more of a reduction in the estimated break-even. We could get into the 18s, but I don't see the group getting down below $18. I don't see it getting to 15, 16. So at this price, at $17, the primary mining industry is still losing money.
Yeah, and it's also set in the context of the demand from industrial usage tweaking upward, and I believe it was the Silver Institute that had noted last year that they expected a supply deficit this year. I wonder if you have current data or news reports that you've seen about the estimation for supply coming downstream.
supply or demand? Industrial demand.
Well, just the ability to meet ongoing demand, the base level being industrial usage, and then in monetary value, fleshing out more investment demand in 2015 and beyond as an assumption. Working their models, I believe it was the Silver Institute, but again, I'm not 100% sure who put this information out, but they estimated that there would be a supply deficit of silver for the 2015 year.
Yeah, I think that was HSBC. And interestingly, HSBC came out and said we might be experiencing peak silver. David Morgan put his new book out, worked with Chris, one of his folks he works with at the silverinvestor.com, that Silver Manifesto. And I spoke with Chris Marchese on the phone, and it's a great book. He believes, according to all the new mines, and he spends a lot of time looking at all these new mines that are coming on, and most of them are primary mines. Mexico, they state that they're going to increase silver production to about 65 million ounces, and they're like 40-something million right now by 2018. I don't know if they'll make it by 2018, but their mines are inexpensive enough where they can do that. But I think Chris said he sees peak happening between 2019 and 2023 with all these new mines coming online. Unfortunately, I tie that into peak oil. If we have peak oil sooner, within the next year or so, which is likely it could happen, especially if the price of oil remains this low, then I see, if there's no black swan, if there's no implosion of the financial system and then the economic system falling, I see maybe peak by 2017, give or take. So now that being said, I don't see industrial silver demand rising that much over the next 5-10 years. A little bit, but again, with peak oil, I don't see industry picking up. What I see picking up is investment demand. And let me give you a quick statistic here. From 2005 to 2014, the world purchased 1.4 billion ounces of physical bar and coin. Now, in that same time period, 618 million went into the ETF. But ever since the price takedown after the peak in 2011 of $50, in the last 3 years, 2012 to 2014, 572 million ounces of physical investment went into physical bar and coin. Now, only 73 million went into the ETFs. Now, we don't know if all that silver is there or how much is actually went into it, but it just goes to show you from the 10-year period, it was double when it's physical bar and coin compared to ETFs. Now it's almost, I think, 8 times the amount since the price has fallen. So we can see investors are physical bar and coin demand. Investors are protected by investing into something they can actually hold. They don't trust the ETFs.
Yeah.
So I hope that answered your question.
It does. You got a qualitatively different type of investor that are making up the buying, particularly in North America now. So that's definitely pretty interesting. Just one quick question. When you said 2017 would be the peak, you were referring to peak silver, correct?
Yeah, peak silver production.
Got it.
And I'm working on this report, and let me just throw this in. The world, well, we still were on a monetary silver, still had silver in our coins. In 1963, the world produced 167 million ounces of official coinage. And the United States was 110 million ounces of that. In 2013, the figure was 118 million ounces of official coins. And these are the ones, the Silver Eagles, the Canadian Maples, the Pandas, Philharmonics, 118 million of those were produced. Now the population, it's been 40-something, it's been 50 years now. 50 years, the world produced more silver coinage in 1963. And now, 50 years later, the population has probably doubled or more than doubled, and now we've produced 118 million. But I believe we're going to see an exponential increase in physical silver investment. And so when we do get a deficit, I think the deficit will come from not industrial, but physical silver investment demand.
Yeah, certainly swings a heck of a lot more than industrial demand. And
yeah, I think according to the
spark.
Yeah, according to the data, there was only, I believe, 35 to 40 million ounces of physical bar and coin demand in the early 2000s. Now it's over 200 million. Industrial has stayed relatively about the same in the last 6-8 years. It's gone up about maybe 10, 15 million and fallen, during the 2009 economic collapse, but it's been about the same in the 600 million range. It really hasn't changed all that much.
Yeah, and with price setting happening at the margin in markets, it wouldn't take that much more investment demand of physical silver to really give the fear of God for industrial producers needing their $2 of silver worth input into a $800 refrigerator or whatever. The material difference for the manufacturer in terms of price is not as important to them. And given how investment demand can make a pretty huge impact with only a modest increase in terms of demanded by the investors, I think that's probably going to be kind of a dynamic that'll go back and forth, a feedback loop, so to speak, at some point in the future. When, who knows? But we'll probably see that.
And we're witnessing the most demand tends to happen when the price really goes low. When the price of silver really goes low, retail for the official coins goes up, and that was proven in 2013. Well, it also happens on the way up. What seems to happen more on the way up is more physical bar investment, which is the 1,000-ounce bars, the 100-ounce bars. And so I really think the Fed and central banks realized that they couldn't have a V-shaped recovery like we did in 2009, where silver went to 50, because if the price of gold and silver really started to get out of hand, there just isn't the physical supply. 118 million ounces of official coins in 2013, there's 7 billion people in the world. That's peanuts. It's nothing.
Start to see the increased demand for the bars, because the first thing to go, obviously, I've always stated, is the 90% silver that's no longer in production. But then after that, it's the official mint coins like Canadian Maples and Silver Eagles that allocate their products, and they don't ramp up production to meet the demand. So then the market has to turn to alternative means of physical, which then is the generic rounds, 10-ounce bars, 100-ounce bars, kilo bars and coins, etc. So that's typically from experience when we've seen increased bar demand and such, and premiums rise on those when the government-issued coins are in very short supply, being rationed, premium spiking. So then investors turn to alternatives that are more readily available and a little bit lower premiums.
Let me qualify that 572 million ounces of physical silver and bar investment demand since 2012 to 2014. That's GFMS based upon their wholesale bar and their official coin. And as you just said, there's a lot of private mints that are selling rounds. There's a lot of rounds out there. Also, there's the numismatics. I was trying to get it to research more of this, but the GFMS does not count the numismatics that are also produced by these official mints. They basically count the bullion, and I'm not quite sure that they count. They don't even count the proofs, the Silver Eagle proofs, the Panda proofs. They don't even count that amount. Now, it's not a lot, but over the years, it does add up. And I would imagine that 572 million ounce figure is probably closer to 700. So there's still a lot of demand taking place, a lot of physical demand. One of the questions I get all the time on my site is how long can they manipulate the price of silver? If they've been manipulating, the elite have been manipulating gold and silver for the last several years and forever, why can't they manipulate it for another decade or two? And that's a good question. And so there's two ways I think the price of silver is being valued. Right now it's being priced what is known as its just-in-time price mechanism based upon its cost, which I said right now the break-even is around $19. And then it's also its supply and demand. So the algorithms, the market, the COTs, the traders, the bullion banks, they're all trading silver, and that's what we're seeing. But that isn't silver's value. And the reason why I believe the price or the value of silver is going to increase exponentially, it's going to really jump, it's because silver and gold are competing not only with the U.S. dollar, they're competing with now $105 trillion in global conventional assets under management. The world perceives there's wealth and there's a store of value in that $105 trillion of the global conventional assets. So gold and silver are stores of value, they're money, and so are these global conventional assets. And once we hit peak oil production and it starts to decline, and it may decline in a disorderly fashion, the value of those paper assets are going to disintegrate because they're only they stay at that high value because there's a growing energy supply. You need a growing energy supply to pay off those assets, or actually just to pay the interest. So once we see this thing kind of break, the dam breaks, and the world realizes that the net present value of these assets are going to fall because oil production is going to continue to decline, then the common sense thing, the light bulb that goes off in the market and in individual investors' minds is to get out of worthless paper that doesn't have real value and into something physical, because gold and silver are stores of economic energy or energy value. You could trade that with something else in the market. Those 105 trillion in global assets under management, those aren't stores of economic energy. Those are energy IOUs. So not only do you have to burn more energy, you have to continue to do that for that system to work. So I want your listeners to realize that when that light bulb goes off, you're going to see a mad rush into the precious metals, and I think we could see crazy prices. There's no limit to how high they can get.
Yeah, it's an interesting dynamic because a lot of people can clearly see, the context of precious metals store of value vis-a-vis just the monetary system and the direct debt-based fiat that is the basis for the entire global monetary system, with the exception of a tiny, example here and there of small countries or whatever. That is something that the precious metals community understands pretty well. But when it comes to the reduction in terms of the ability to produce energy to do work, and its most basic definitional level of energy is the ability to do work from an economic point of view, less energy availability will result in less economic activity, and it's a deflationary pressure that can be quite wicked in its feedback loop. So the store of value in terms of assets that people look at for financial assets that are paper-based versus something that's physical, and the store of value definitely shines through in that example. That's a fascinating discussion that we should probably jump later on in the conversation, but also to just recap what's going on with peak oil, because there's a lot of confusion as to what it actually means, where we are, how it will possibly unfold in the future, and maybe that's a good time to jump into that discussion because it piggybacks on what you just discussed.
Yeah, Eric, I think the problem is we hear a lot from the precious metal analysts, and you see, I find this is one of the most frustrating parts of my work. Precious metal people want to talk about precious metals. They want to talk about geopolitics and then, the debt-based system, but they don't want to talk about energy, or they don't want to look at energy. And then the energy guys who I follow, who I think are among some of the top energy analysts out there, they don't care about gold and silver. And it's like they're still invested in the paper system while they realize that peak oil is going to come here shortly, which is going to destroy, let's say, their retirement. these guys who are retired oil geologists and engineers, but they're still invested in that. And I'm completely surprised why one side can't see the other. Now, that being said, peak oil will happen just like we had peak whale oil. I mean, you can't go out and get the whale population has been decimated anyhow. But peak oil takes place because what happens is you get to you can produce so much, you continue to add new oil fields on. And in the United States in the early 1900s, we were bringing on these oil fields that had energy return on invested in the hundreds and thousands. I mean, the Lakeview, California oil gusher in the 1900s, I think it was 1911. They got a plaque out there. If you go on the small interstate, the small highway in California, there's a plaque out there. That thing was uncontrolled for 8 months. Its energy return on invested, they calculate, was 35,000 to 1. So there you go. You've got this one oil field that produced so much oil, they couldn't get it under control for 8 months. There was lakes of oil. We don't find those anymore. Those are gone. We still find some oil like that, but we don't find it anymore. So what are we doing? We're in the Bakken and Eagle Ford, and we're producing that at 5 to 1 energy return on invested. So when someone says there is abiotic oil, and that's a big object. People believe that. They believe that the oil fields are deep. It's made deep in the earth. And so the oil fields are going to refill. Well, if they were refilling, why would the oil industry be losing money going after the back-end oil at 5 to 1 when they can just keep the oil rigs in those old fields and make a lot of profits? And so that's one way people think. They think this oil is refilling. Well, the math on the falling energy return on invested tells us that that's not taking place. It's mathematically impossible. And then the other thing is we've got 1 trillion barrels. We've got more oil here in the U.S. than Saudi Arabia. Well, you have to quantify what a barrel is. Saudi Arabia has light sweet crude, and that stuff flows like water. Now, the 1 trillion barrels that we have in western U.S. is shale. It's not shale oil like we have in North Dakota. It's oil shale. It's crappy shale that you got to crush it and heat it to extract. Well, that's not oil, and its energy return on invested is less than 2 to 1. So if we're not making, it's got kerosene in it. It's not oil. So when someone says we have 1 trillion barrels, they don't know what they're talking about, because if the back end isn't really economic. It was barely economic at 100. It's not. It's a huge net energy loser, or a huge debt at $50. Why would anybody try to go after the 1 trillion barrels of crappy oil shale in the West? So when you realize those two things, we're going to peak in unconventional shale oil production shortly, and when that occurs, it's going to take time, Eric and Doc, for the world to figure this out. And yes, some people said we were going to peak earlier, but in retrospect, the high oil price allowed that shale oil and tar sands to come on. And here's what's interesting. In 2014, the U.S. had 1,600 drilling rigs for oil, just for oil, 1,600. Do you know how many Saudi Arabia had? 62. So Saudi Arabia in 2014 was producing 157,000 barrels of oil per drilling rig, where the U.S. was producing 5,600. Now, in February, the Middle East actually increased its drilling rigs 18%. And Saudi Arabia, I believe, is now up to 75 oil drilling rigs. Well, the U.S. is now they've dropped in half to 825. So it goes to show you that the price of oil in the U.S. has to be high for us to drill, where in Saudi Arabia and the Middle East, they can still bring on more drilling rigs and produce a profit at a much lower price, even though they have to support their national societies on their state income. But the U.S. oil industry is in severe trouble. Nothing happens overnight. It takes time. But we're going to see this low oil price. I think we're going to start seeing some serious bankruptcies in the shale energy companies.
I'm doing this completely off the top of my head, but if I remember correctly, in the 1950s, the United States was producing about 10 million plus barrels per day, but 100% of that was conventional oil. And now, we're, 9 million, somewhere around there, a little less maybe, and just about 6 million of that is shale oil. Shale oil fields have a peak and decline that, takes place within a 3-year period, easily in most cases, depending on the geology of what fields you're talking about. And, that speaks to that example of the differences between what Saudi Arabia has been doing with their rigs and how much they produce versus the United States. And the take-home point with all of this is that people looked at the shale boom in the last couple of years and just said, hey, peak oil is a myth. These guys don't know what they're talking about. But the reality is that it's like the United States having to run ever faster and ever more aggressively with the use of technology to squeeze more oil out of the sponge, so to speak, of our reserves. I don't think a lot of people understand the differences between what shale produces versus a conventional oil field, and we did in fact see worldwide conventional oil peak in 2005, and it has remained as such. I think it peaked at like 77 million barrels per day, if memory serves.
Yeah, that's correct. Conventional did peak. As a matter of fact, if we take out the U.S., the rest of the world, let's just say all oil. Let's even include unconventional from Canada. Overall oil production is down in the rest of the world if we take the U.S. out. And now that you brought this up, I have some interesting conversations. I had a gentleman who was the president of an independent oil company in Texas, and he is an oil geologist. He looks for oil, knows everybody, just about everybody, looking for oil in Texas, Louisiana, and Oklahoma. And those were the 3 big states where we found a lot of oil. And this gentleman actually worked with Bunker Hunts, the Hunt brothers. And now I believe he works with their grandchildren. And he still finds oil. He can still find million barrels of oil. It's not a lot. We use about 19 million barrels a day. So what is that? A little bit less than an hour. But what he finds is conventional oil that has a pretty good return on investment. He would never go after shale. And most of the people he deals with are the same way. Because you see, the shale oil, and here's another problem. When you have a conventional oil that is, let's say, a 25, 30 energy return on invested, there's a lot of profitable barrels that you could use to maintain infrastructure, bridges, you can have hospitals, you can have entertainment, you can have restaurants, you can have all these manufacturing. You need those profitable barrels. You see, what people don't realize, shale oil at 5 to 1, there's not enough profitable barrels to maintain this very complex system. So when someone says, we'll just use more technology, we'll throw more technology and we'll solve the problem. You see, the problem is technology makes the energy return on invested fall because technology costs a lot of money. So if you use more technology, you're actually you're using more energy to get that energy out. And when that energy falls, that ratio, that energy return on invested, it puts severe stress on the system. And let me just tell you, I'm looking at Art Berman. He's one of the top energy analysts. He did a overall spreadsheet here of the top shale gas companies. Gas, this is not oil. In 2013, their free cash flow was negative $8 billion. In 2014, it doubled. It's negative $15.5 billion. Their total debt in 2013 was $83.7 billion. It's now $93.5 billion. How on earth, if you're not making free cash flow, how do you pay back your debt? You have to make profits to pay back your debt. So all these people who regurgitate that there's no peak oil, they're not looking at the numbers. I mean, now the majors, their capital that they're spending every year is increasing. And their operation cash that they get from what their revenues, their operation cash is falling. It's a big pinch. And these are the major oil companies. I mean, the small and mid caps are getting destroyed out there. The debt levels are increasing, and there is no profit. A few of them are making profits because a few of them got into the sweet spots early. But the overall industry is in serious trouble.
So, Steve, before we wrap it up, let's tie this to gold and silver specifically, like over the next 5 to 10 years. What are the implications then looking forward for the miners and then with result to the actual physical metals?
If people don't understand this energy dynamic, energy is the driver, finance is the steer. If they don't understand energy, they're going to get caught up in what's taking place. And right now, Silver Eagle demand is down a little bit. And I kind of realized if we didn't get, let's say, a price down to $9, $10, if we remained at this 15, 16, 17, it's not inspiring people to buy record amounts of Silver Eagles. I think this first quarter, Silver Eagles may reach 12 million. That's what the retail, that's what it looks like. Last year, it was almost 14 million. So we had more buying. I think over the next couple of months, maybe even year, if things remain the same in the markets, we don't have any big black swans or any major events, I think we will see the Silver Eagle demand fall compared to last year because there's real no motivation to excite people to get into it. And even Indian silver imports are down in the first month or so. They're down compared to what they were last year. So what we're seeing investors are becoming complacent with this $15, $17 range. The system's going on. But now, as the next few years unfold, and I do believe we're going to see peak global oil production within this next year or so, as oil production declines, it's going to put more stress on that debt-based system, the dollar, the treasuries, the global conventional assets. So I don't know how this unfolds, Doc, but at some point in time, we're going to see convulsions. And that's the way it happens. It's convulsions, and more people are going to wake up because when they come to my site, half of the people that come to my site are unique visitors. They're brand new eyeballs. And so they might not be buying silver, but they're thinking about it. So I see over the next 5 years, I believe by 2020 the world will be a different place. I think peak oil, unconventional peak, will finally push the death of the U.S. debt-based dollar treasury system. And I think we're going to move more into a physical backing monetary system. And then it'll be difficult to get the actual physical silver or gold, which is why I also believe it would be wise to have a small percentage of your money in physical, in the primary silver miners, better than the gold miners, but in the primary silver miners, because you might not be able to get the silver, but the primary silver miners are still going to produce the silver, and they're going to get the huge increase in their stock price. So again,
so is it a big mistake to be complacent here in 2015?
With the geopolitics that are taking place in Ukraine and now in Yemen, as you mentioned in the beginning of the interview, anything can happen. Anything can happen. And when you see, it's like insurance. If you say, well, I'm not going to get fire insurance for my house or this insurance for my house. If you've got bare minimum insurance, and then all of a sudden the fire comes through, you can't buy the insurance the day after the fire. And this is the complacency. The problem is you never know if your house is going to catch fire. The U.S. dollar, the whole system will catch fire. It will. We're not quite sure when that's going to take place. So each day, each week, each month it passes by, people tend to get more complacent, and then all of a sudden it'll be too late. I think buying silver today at $17, even though it could go lower, it's like ammo. You can't get 223 ammo now. and 22 is almost impossible to find. And the prices of the ammo is ridiculous. And so that's, I think, what's going to happen. What happened to ammo will happen with gold and silver, and especially silver because there's a lot less of it available. So I think buying silver at these prices today it's probably the best investment anybody can make.
All right, well, before we let you go, Steve, I know regular readers of Silver Doctors are very familiar with your work, but for perhaps those listeners who aren't, if you could let them know where to find your regular work that both Eric and I highly recommend as some of the best analysis on both silver, gold, as well as the oil markets out there.
Okay, you can find my work at the SRSRocco report, and I publish about 3 articles, sometimes 4 articles a week. I try to keep 1 or 2 that are my own articles, and I try to incorporate energy and some of the economic situation that's happening, as well as I focus on the mining industry, silver, investment demand, gold, investment demand, and so I'm happy to have anybody come take a look.
Steve does a great job too about taking complex interactions and numbers and boiling them down into understandable charts, and his explaining of economic dynamics is really great. I think it's accessible to the layman, so I highly recommend it. I think people will check it out. Do you have like a free trial or something along those lines?
Well, Eric, I had planned. Actually, the reason why I started my site, Jim really called me up from Costa Rica, and he said, "Steve, you need to get a site going, and you need to start having subscriptions." Well, I'm a type person. I don't do well under pressure. I don't like to have to put out material just to put material out, just to make a buck. And I'm not saying Jim really does that. He's one of the few that does a great product. But I think there are a lot of them out there that put out material that they're just filling space and trying to keep subscribers. So I never did that. But I have mentioned I was going to have some modestly priced paid reports. So my site has been free. There's archives. A new person could spend a lot of time on it. But I will be publishing some modestly priced paid reports that will help people understand more of the fundamentals on silver, energy, and the primary silver miners.
All right, Steve, it's always a pleasure. It's great to have you back.
And it's always great talking with you, Doc. And you too, Eric.
That'll wrap this week's show. For the Doc, Eric Dubin, and Steve St. Angelo of the SRSRocco Report, thanks for tuning in to this week's ST Weekly Metals and Markets.